Private lenders in Ontario did something a lot of banks didn't. They grew. In 2023, private mortgage made up almost 17% of all residential mortgage organizations in this province. That's not a rounding error. That's real money moving outside the banking system into deals between individual lenders and individual borrowers. And the pitch sounds incredible. Double-digit returns backed by real estate. Way better than a GIC. So, is it actually a good idea? Or is it just a high-yield trap with a mortgage attached? Let's break it down properly. Just what you actually need to know before you put your dollar into this. Hi, Kane here. I was a theater grad that started as a starving artist. 20 years later, with a lot of hard work, I own properties throughout Ontario. Watch my biography video to see how I struggled. This information is for educational purposes only. If you are going to invest, please consult with a professional. Be sure to read the references in the description below to see where I pulled this information from. Okay, without further ado, let's get started. Private lending, specifically private mortgage lending, is simply in structure. You, the lender, advance money directly to the borrower. Could be an individual or a small corporation, a real estate investor, or a mortgage investment entity. In exchange, you get a mortgage registered against a property as your security. No bank underwriting department standing between you and the risk. No CMHC backstop. Just you, the borrower, and whatever due diligence you did or didn't do before signing. That's the entire appeal, and it's the entire risk in one sentence. First, the legitimate upside, because there is one. Private loans pay more than the conventional fixed income because you're accepting more credit risk, more liquidity risk, and more enforcement risk. A properly registered mortgage gives you an actual legal claim against a physical asset. That's very different from an unsecured loan or a stock position. Negotiated terms. You're not accepting a rate a bank algorithm spit out. Interest rate, loan-to-value covenants, repayment structure, all of that can be shaped to reflect the actual risk in front of you. Your return isn't tied to what the TSX did this week. For some portfolios, that diversification is real. Most private mortgages run 6 to 24 months. Your capital isn't locked up for a decade like a long bond or real estate development fund. That's the case for it. Now, here's the part that pitch decks skip. Default and principal loss. The borrower stops paying. The property doesn't sell enough to cover the loan plus legal costs, plus enforcement costs, and you're the one absorbing the shortfall. Ontario's own regulator, FSRA, names this explicitly as the core risk for private mortgage investors. Illiquidity. You can't sell a private mortgage the way you sell a stock on a bad Tuesday. Your money is tied up until maturity, refinance, sale, or, worst case, the end of an enforcement process that can take months. The due diligence burden falls on you. Nobody's bank underwriting team is checking the borrower's income, the property's real value, existing liens, tax arrears, or the exit strategy. If you don't do that work or someone trustworthy does it for you, you're lending blind. Legal and enforcement costs. If a deal goes sideways, lawyers, appraisers, and possibly a court process eat into your return fast. On a smaller loan, that can wipe out most of the upside you are chasing. Fraud and conflicts of interest, inflated appraisals, undisclosed second liens, renovation budgets that were never realistic. SRA have flagged all of these as recurring problems in this space, which is exactly why who's structuring the deal matters as much as the deal itself. Concentration risk. One mortgage is one borrower and one property. A single bad valuation or single legal misstep can turn a conservative loan into a real loss. Here's the number that should stick with you. A 10% return is bad trade if there is a real chance of losing 30 to 100% of your principal. The rate on the label means nothing without the underwriting behind it. Private lending isn't reckless by default, but it's only appropriate under specific conditions. It can make sense when This is capital you generally don't need for years. It's a small slice of a diversified portfolio, not a core holding. The loan to value is conservative, meaning based on current value, not some optimistic after renovation number. The borrower has a real repayment source, not just a hopeful refinance story. An independent lawyer, one you retain, not one the borrower suggested, reviewed and registered the security. You have a clear plan for what happens if the borrower stops paying. And it should be an immediate pass if any of these are true. You need this money within years, or you're funding it with borrowed money or a HELOC. It's a large share of your net worth. Or you're relying entirely on someone else's appraisal and someone else's word. FSRA specifically warns against borrowing against your own home to fund a private mortgage investment. If you take one line away from this video, take that one. Before capital moves, there are non-negotiables: an independent appraisal, a full title and priority search, a conservative loan-to-value calculation, analysis of the borrower, income, credit, experience, and clearly defined exit strategy, a proper written legal agreement, and independent legal counsel who isn't chosen by the other side. It can be as a carefully sized collateral-backed piece of an income strategy for someone who can evaluate the borrower, the collateral, and the legal structure, or who's working with people who actually do the work properly. It is not suitable for an emergency fund. The question is never, is the rate attractive? The question is the underwriting strong enough to justify the risk? If you enjoyed this video, be sure to watch my next one on what are the best Canadian investments out there. Thanks for watching.